Welcome to the lecture on corporate accounting. In this lecture, we will discuss about liquidation of companies. Liquidation simply means winding up of the company to close down the business of companies. So, this can be done by selling all the properties of the business. We call it as assets in accounting terms. Selling the assets and paying off the dues, that is liabilities, all types of debts and outstanding expenses such as legal expense or liquidation expenses or dissolution expense. So assets can be plant and machinery, furniture and fixture, land and building, etc. The liabilities can be outstanding amount to the creditors. Raw materials are purchased on credit and they are the suppliers of the business. If loan taken from the bank or any other financial institution, and some expenses. So after this procedure, that is selling the assets and paying off the dues and debts, it means it is the death of the company in the eyes of law. The company does not exist thereafter. So liquidation of company means winding up of the company or to shut down the business of the company. But in the legal term, these can be classified into two categories: winding up as per Companies Act 2013 and liquidation under Insolvency and Bankruptcy Act 2016. So, winding up includes two categories: winding up as per Companies Act 2013 and liquidation under Insolvency and Bankruptcy Act 2016. And the company can be liquidated either by petition or voluntary wind up. Petition for wind up can be filed by company itself or by any contributor or registrar of companies or any other person authorized by central government on their behalf. And in case the affair of the company is conducted in a fraudulent manner, then central government or state government can interfere and company comes to an end. So, what are the steps involved in liquidation of companies? First of all, company will sell off all the properties and assets of the company. Then the liabilities will be paid off. These are the outsiders liabilities such as payment to the creditors and bank loan repayment, and all types of expenses will be paid such as legal expense or any other outstanding expenses such as electricity bill, rent outstanding, salary to the employees are outstanding. Then the remaining amount will be distributed to the debenture holders, preference shareholders, and equity shareholders. Now, when we talk about payment to the liabilities such as creditors, it also includes the debt to the government such as tax payable or duties payable, the employer contribution to the employee provident fund, pension fund, etc., gratuity and compensation to the employees in case of death and disablement. Now, what are the accounts to be prepared in case of liquidation of companies? So, there are two important factors to be considered. The winding up of the company is by tribunal or is it voluntary wind up? The winding up of the company is by tribunal or is it voluntary winding up? If the winding up of the company is by tribunal, then statement of affairs is to be prepared. And if it is voluntary winding up, then statement of accounts is to be prepared. Generally, we call it as SOA, statement of accounts. The debit side is receipt side and credit side is payment side. Point will be assets realized on the debit side, because if assets are sold, then there will be receipt of cash. So it will come on the debit side. Debit what comes in, cash comes in. Therefore, the amount will be recorded on debit side. Next, surplus amount of secured assets. And third point, call in arrears, the outstanding amount of shares, the face value of the shares which a company has called up, but the dues are not yet paid by the shareholders. So it will be call in arrears or unpaid amount of call money. So call in arrears will also be received from the shareholders. Then fourth point, legal expenses. This is with respect to liquidation of company. Liquidators expense. Next, payment to the debenture holders. Creditors. Creditors can be further classified into preferential creditors. Preferential creditors are government tax, outstanding amount of salaries, wages, and pension fund, provident fund, etc. Gratuity fund. Next, unsecured creditors. These are the person from whom goods are purchased on credit and money is payable. Then preference shareholders, the total of debit side and credit side will be done, and the balancing amount, if the receipts are more than payment, then there will be surplus available. This surplus will be paid to the equity shareholders. That's why equity shareholders are called as residual claimants, because only the surplus amount will be paid to the equity shareholder. If there is a deficit amount, then the equity shareholders will be liable to pay the liability up to the value of share. So, what are the accounts to be prepared in case of liquidation of company? So, we have two questions. If liquidation is done by tribunal, then statement of affairs is to be prepared. And if it is a voluntary winding up of the company, then statement of accounts is to be prepared. And the balancing amount will be transferred to equity shareholders. It will be distributed among equity shareholders if there is a surplus. But if there is a deficiency, then it will be called upon from the equity shareholders up to the face value. Therefore, deficiency account is transferred to balance sheet asset side. For example, if the called up value is 7 rupees out of 10 rupees, then if there is a deficiency on the account, then the balance 3 rupees will be called upon from the equity shareholders to pay off the liability. So the equity shareholder liability is up to the value of shares. The face value of the share, for example, if the face value of share is 10 rupees and 7 rupees is called up by the company, then additional 3 rupees will be called upon in case of liquidation and if there is a deficiency in the account. Now let's understand the concept with practical example. Mindtree Limited went into liquidation on 1st April 2020. Following is the details regarding share capital of the company. 20,000 equity shares of 100 rupees each, 75 rupees paid up, 30,000 equity shares of 100 rupees each, 40 rupees paid up, and 80,000 equity shares of 100 rupees each, 65 rupees paid up. It means there are total 1,30,000 equity shares available in the company from which the money is due up to the face value. It means 75 rupees is paid up, but 25 rupees is unpaid. So the balancing 25 rupees will be called up by the company from the equity shareholders. In second case, out of 100 rupees of face value, 40 rupees is paid up by the equity shareholder. It means balance 60 rupees is not yet paid. So company will call up the remaining amount from the equity shareholder, and equity shareholder will pay the remaining amount because the equity shareholder liability is up to the face value of share. And in third case, 80,000 equity shares of rupees 100 each is the face value, and out of 100 rupees, 65 rupees is paid up. It means balancing 35 rupees is not yet paid. So it will be called up by the company. Surplus available to the liquidator after discharging all the liabilities is 20 lakh rupees. Total 20 lakh rupees is surplus available. It will be distributed among equity shareholders. Distribute this surplus money among different categories of shareholders. Different categories means these three categories of equity shareholders. So this is the question, and there are three categories of equity shareholders who have paid different amount of paid up money. Three categories of equity shareholders. We will start with number of shares. So 20,000, 30,000 and 80,000 respectively. Total 1,30,000 equity shares are there. Equity share capital of 100 rupees face value each. Face value is 100 rupees. So 20,000 into 100 rupees. 20 lakh rupees. 30,000 into 100 rupees. 30 lakh rupees. 80,000 into 100 rupees. 80 lakh rupees, and total is 1 crore 30 lakh rupees. Next, paid up capital. This is the paid up money. We will multiply the paid up money with equity share, number of equity shares to arrive at paid up capital. So 20,000 into 75, 20,000 shares into 75 rupees, 15 lakh. 30,000 into 40, 12 lakh. 80,000 into 65, 52 lakh. Total 27 plus 52, 79 lakh. Paid up capital is 79 lakh rupees. Surplus available 20 lakh rupees. So we have surplus amount total 20 lakh rupees. So balancing figure will be loss due to liquidation. 79 lakh minus 20 lakh, 59 lakh rupees loss due to liquidation. And these 59 lakh rupees will be distributed among each categories of equity shareholders in the proportion of equity share capital, that is 20 lakh, 30 lakh and 80 lakh, or 2 is to 3 is to 8. This 59 lakh rupees will be distributed among each categories of equity shareholder in the proportion of their capital. 2 is to 3 is to 8. So 59 lakh multiplied by 2 divided by 13, the total of proportion. 59 lakh multiplied by 2 divided by 13, 9 lakh 7,692 rupees. 9 lakh 7,692 rupees. Next, 59 lakh into 3 divided by 13. 15 lakh into 3 divided by 13. 13 lakh 61,538 rupees for category 2 equity shareholders. Or we can even deduct the amount from 59 lakh rupees. So the amount will be 36 lakh 30,770 rupees. Then A minus B 15 lakh minus 9 lakh 7,692. The amount will be 5,92,308. 5,92,308. Next, 12 lakh minus 13 lakh 61,538. 1,61,538 in negative. And 52 lakh minus 36 lakh 30,770. 15 lakh 69,230. So the conclusion is category 1 and category 3 equity shareholders will get surplus of 5,92,308 rupees and 15,69,230 rupees respectively, and category 2 equity shareholders will pay the 1,61,538 rupees. Nilkamal Limited went into liquidation on 31st March 2022. Following is the details regarding share capital of the company. 3 categories: 15,000 equity shares of 100 rupees each, 90 rupees paid up. 15,000 number of equity shares, face value of rupees 100, and out of 100 rupees, 90 rupees is paid up, 10 rupees is unpaid. Second category, 40,000 equity shares of 50 rupees each, 25 rupees paid up. And third category, 2 lakh equity shares of 10 rupees each, fully paid up. This is the face value, this is number of equity shares, and this is paid up capital. Surplus available with the liquidator after payment of all the liabilities is 12 lakh rupees. Distribute the surplus money among different categories of equity shareholders. So this is the question, and 3 categories of equity shareholders: number of equity shares, face value of each equity shares, and paid up amount of equity shares. This is the surplus money. We will solve this question same as previous question. So number of shares are 15,000, category 1, 40,000, category 2, 2 lakh, category 3. Total number of equity shares 2 lakh 55,000. Equity share capital When we multiply the number of equity shares with face value of equity shares, we will get equity share capital. So 15,000 equity shares multiplied by 100 rupees, the amount is 15 lakh. Similarly, 40,000 equity shares of 50 rupees each, 40,000 into 50 rupees, 20 lakh rupees, and 2 lakh equity shares of 10 rupees each, 20 lakh rupees. Total 20 lakh plus 20 lakh plus 15 lakh, 55 lakh. Paid up capital we will get by multiplying number of equity shares with paid up value, that is 15,000 into 90 rupees for category 1, 13 lakh 50,000. Similarly, for category 2, 40,000 into 25 rupees, 10 lakh rupees. And for category 3, 2 lakh into 10 rupees because the shares are fully paid up and face value is 10 rupees. So 2 lakh shares of 10 rupees each, 20 lakh rupees, and total will be 43 lakh 50,000 rupees. 13 lakh 50,000 plus 10 lakh plus 20 lakh, 43 lakh 50,000 rupees. And additional information is given, 12 lakh rupees surplus. So surplus amount distributed among different categories of shareholder is 12 lakh. First, we will find out the balancing figure because we have point A and point C and the difference is point B. So 43 lakh 50,000 minus 12 lakh, we will get 31 lakh 50,000, and it will be distributed among equity shareholders in the ratio 15 is to 20 is to 20, in the ratio of equity share capital, that is 15 lakh 20 lakh 20 lakh, 15 is to 20 is to 20, or 3 is to 4 is to 4. When we divide this by 5, we will get 3 is to 4 is to 4. So 31 lakh 50,000 will be distributed among 3 is to 4 is to 4, that is 31 lakh 50,000 into 3 divided by 3 plus 4 plus 4, 11, 31 lakh 50,000 into 3 divided by 11, 8 lakh 59,091 rupees. 8 lakh 59,091 rupees. We will round off the amount. 8 lakh 59,090 rupees. Then 31 lakh 50,000 into 4 divided by 11, 11 lakh 45,455 rupees. Similar amount is for category 3 equity shareholders. Now A minus B, 13 lakh 50,000 minus 8 lakh 59,90 rupees. The amount will be 4,90,910 rupees for category 1 equity shareholder. Similarly, we will do for category B and category C. So conclusion is category 1 equity shareholders and category 3 equity shareholders will get surplus amount of 4,90,910 rupees and 8,45,545 rupees respectively, and category 2 equity shareholders will have to pay 1,45,455 rupees. So this is how accounting treatment in case of liquidation of companies to be done.